Welcome to the 3 Edge Week in Review for the week of October 3rd. I'm Fritz Folts, the Chief Investment Strategist here at 3 Edge, and joining me here once again today is Steve Cucchiaro, CEO and Chief Investment Officer here at 3 Edge Asset Management. Today, Steve and I will be discussing how even though stocks have struggled mightily this year, bonds are actually having their worst year of investment performance ever. It certainly seems that the declines in the stock market thus far in 2022 have overshadowed just how bad the bond market has performed year to date. So let's dig in and see why it is bonds have struggled so mightily thus far in 2022, and whether at current yields, bonds may actually be attractive. Before we do that, let's just review a few key concepts when it comes to understanding the bond market. Bond yields and bond prices. Bonds can be confusing because bond yields and bond prices have an inverse relationship. This means that as bond yields rise, the principal value of bonds actually declines. Conversely, bond yields fall, the principal value of bonds rises. So what's important to understand, particularly this year, as the Fed aggressively raises interest rates, is that as interest rates and yields rise, the principal value of bonds declines. In addition, there's another important element when it comes to understanding the bond market, and that is the concept, something known as a bond's duration. And duration is a way to explain just how sensitive any bond is to changes in interest rates. Duration explains the severity of the rise or fall in a bond's value caused by changes in interest rates. When interest rates rise, the higher a bond's duration, the more its price will fall. Now, people often confuse a bond duration with its term or its maturity, but these are not exactly the same. However, for our purposes in our discussion here today, it's just important to understand that when interest rates rise, the higher a bond's duration, the more its price will fall. So, Steve, let's get started. And maybe you could just describe just how bad the bear market of 2022 in bonds is relative to other bond bear markets.
Well, Fritz, as you mentioned, the stock market has been having a terrible time. A lot of focus has been on the stock market. In 2022, the stock market is having its worst year to date since the year 2002, 20 years ago. Bond market, even worse. We have data going back to 1871. There's never been a bond market that's done worse in the first 9 months of a year than this year. And second place is not even close. Now, instead of just looking year by year, let's look at a longer period of a bond bear market. The biggest bond bear market we had was from the early 1940s to the early 1980s. It was a period of rising interest rates, rising inflation. And we have a chart that shows how an investor would have lost more than half their wealth as a bond investor relative to inflation. And then we show how does the current market, starting in the mid 2020 period, how does the current bear market in bonds compare? And you can see we're even off to a worse start. And so bonds this year, even the safest bond one can think of, the 10-year US Treasury bond, it's down over 15% year to date. Other bonds are even worse. So international bond indices, high yield bond indices, even doing worse. So we are definitely off to a bad start.
All right, great. So now let's just take a look at why bonds are having such a bad year and what might bring an end to the declines that we've experienced thus far in 2022 in the bond market.
Well, to help understand why we're having such a bad year, we need to understand that we're falling from a very lofty perch.
Right.
As you mentioned, Fritz, when interest rates go down and yields are going down, the principal value bonds go up. And in mid-2020, we had the lowest interest rates and the lowest yields, bond yields, around the world in history. There was a study that looked at 5,000 years of interest rates, and they've never been lower than they were in mid-2020. So you can say it was an enormous asset bubble in bonds. Bonds are tremendously overvalued. They benefited from tremendous stimulus and low inflation. And So what that meant was they were extremely vulnerable to any rising inflation and or the withdrawal of the extraordinary monetary stimulus and fiscal stimulus that central banks and that the government was providing. Well, now we're having a sharp rise in inflation. We're having a sharp rise in the Fed funds rate that the Fed sets, and other central banks have their own rate rises. The fiscal stimulus continues, which helps support the inflation pressures, and it causes increasing debt levels. On top of that, you have quantitative tightening, meaning that the Fed, instead of printing money to buy bonds, they're actually uh, they stopped printing money to buy bonds and they're actually going the other way and selling bonds to the market or letting them roll over without buying them back. So all of this has caused a sea change in the forces that were causing bond prices to go up. And that's one reason why we have bond prices really crashing. Now, you mentioned, well, what could cause an end to it? And certainly, if we had a deflationary recession or depression, if all of a sudden inflation were to unexpectedly plunge beyond any expectation, then maybe the Fed changes, completely pivots, and they turn things around and they start printing money again. Well, that could cause yields to come down. But until that happens, we might get continued decline in the bond market.
All right, great. So, as always, my final question is based on what we've discussed here today about the brutal year that bond investors have faced thus far in 2022, and with yields decidedly higher than they've been in many years, what might the implications be for investors' portfolios? Do you think that perhaps the worst of the bond market damage is over, or are bonds attractive at these yields?
Even though we've had a big decline in bond prices and a big rise in yields, we're still below average.
Mm.
And until we are confident that inflation is going to get back down to 2% level, I think one has to be leery long term about bonds. So one thing that I have sympathy for are that after the bond bear market from the 1940s to 1980s, we had the most fantastic bull market from the early 1980s until 2020. And a whole generation of investors, a whole generation of money managers, in fact, learned during that bull market that bonds were a good hedge against equities. If equities were doing badly, you could count on bonds doing well. And it's because we were in a period of falling interest rates and falling inflation. So when that all changed in 2020, investor strategies didn't change. Many investor strategies didn't change. Many money manager strategies didn't change. It's always easy to do what was successful in the past. So we have a period where people were not getting the hedge they expected from the bond market, and bonds and stocks were both going down in an extraordinary way. And that's been painful for investors. And so bonds are no longer acting as a hedge for stocks. So what we think is that this certainly could continue. We would recommend, based on our models, still it's time to be prudent and stay defensive in the stock market. As long as bond yields are rising, that doesn't help stock valuations. And stocks are coming down from their own overvalued territory. We think in the bond market, you mentioned duration, one should stay away from long duration, which is riskier if interest rates continue to go up, and move into very short duration cash equivalents or very short-term bonds where the duration risk is much, much less. Any rise in interest rates won't really hurt the principal very much at all, or maybe not at all if it's a zero duration bond like a floating rate bond. And then have some modest diversification into real assets, which can serve as a hedge against geopolitical uncertainty. And there's certainly plenty of that.
Excellent. Great. Thanks. And thanks for shedding some light on how and why this has been such a difficult year for bonds and what may lie in store for the bond market in the fourth quarter of this year into 2023 and beyond. So that will do it for Steve and me for this week. As a reminder, all our videos are available on our 3Edge YouTube channel. If you would be willing to subscribe to our YouTube channel, we'd be most appreciative. In addition, all our videos and all our written commentaries are always available on our website, and that is 3edgeam.com. So until next time, on behalf of Steve and everyone here at 3Edge, Thanks for listening.